Hi, my name is Ed Castellani, and I'm a business and tax attorney with Fraser Trebilcock, a law firm here in Lansing, and we serve as attorneys to the Greater Lansing Association of Realtors. And, okay, all right. When Courtney called me to speak today, she said Matt's going to do a presentation on state tax updates, and Matt had all these wonderful state changes that he could talk about. And she said to me, can you talk about federal tax changes for real estate? And I said, well, I can do that, but it's going to be a real short presentation because there really haven't been any recent federal tax law changes that affect real estate. You know, Congress is so busy with healthcare and the economy and all the other things that they're doing, there really haven't been any federal changes. And I said to Courtney, well, but I handle a lot of closings, I handle a lot of real estate tax issues, and I get a lot of calls from realtors. I said, why don't I talk about some of the calls that I get, some of the issues that I handle, because if they're important to folks that are calling me, they may be important to other people. So she said, that sounds like a great idea, why don't you talk about that? So that's what I'm doing. So the first issue I've got to talk about, and the question that I get a call on from time to time, whenever we have a closing in our office and someone's going to sell their residence, they'll say to me, geez, I'm going to sell my residence. How much tax do I have to pay when I go ahead and sell my home? And actually, Congress has been very generous in this regard. Under current law, if an individual sells their residence, they can exclude up to $250,000 of gain on the sale of their residence. If they're married, they can exclude $500,000 of gain. There's a couple of caveats to that, and that is that they had to live in the residence for 2 years out of the last 5. In today's economy, today's real estate market, we don't see too many transactions where folks have more than $250,000 or $500,000 of gain on their sale of residence. I mean, not some folks that are maybe as old as me remember a day when you could buy a residence in some parts of the country, or maybe even some parts of Lansing, and hold it for 2 years, and you could have some substantial gain on it. But we don't see that much anymore. And the 250 and the 500, that's actual gain, that's profit. You know, that's not the sales price. As I said, you had to live in the residence for 2 years out of the last 5. An exception to that is that 2-year rule does not apply if the sale, if there was a job change and you had to sell your house because of a job change. So aside from that, each individual gets $250,000. A married couple gets $500,000. They sell the residence, no tax at all. If anybody ever has any questions, just raise your hands and I'll see if I can answer it. All right. Another benefit of owning real estate, and it's something that I'm involved with quite a bit, is what's known as a tax-free exchange of real estate, or like-kind exchange. And what we mean by this is that a taxpayer can sell the property, they can take the proceeds and invest it in another property, and they don't have to pay any tax on the sale of that first property. Now, in order to do that, though, you got to follow some pretty specific rules. For instance, the property that you exchange it for has to be what they call like-kind. And like-kind, fortunately, is very broadly defined. Almost any type of real estate other than your personal residence or what's known as inventory. If you're a developer and you've got a number of houses for sale, those are considered your inventory, so those don't qualify for a tax-free exchange. But aside from those, almost any investment property qualifies as like-kind exchange. For instance, a residential property for a commercial property, apartment building for a strip mall, almost any investment property will qualify. So that's a good thing. And when you do a tax-free exchange, it doesn't mean that I'm going to give you a deed to my property and you're going to give me back a deed to your property. It's very unlikely. There's never 2 people in the world that are going to want each other's property. So Congress has actually liberalized how you can accomplish a tax-free exchange. And the way that it works nowadays is that a seller can sell their property, cash comes into the seller, but the seller themselves can't hold that property, or the seller's agent can't hold that property. An agent would be like the seller's attorney, the seller's realtor, the seller's accountant. They cannot hold that cash. You have to go to what's known as a qualified intermediary, is what the tax code calls the party that can hold the cash. And nowadays, that's, for the most part, title companies or banks are providing that function. Mostly I see title companies doing that. And title companies are very good at doing it. They charge about maybe $500 or $1,000 to serve as an intermediary. And they know the rules, they know what you can do and what you can't do. And so when the sale is made, that money is going to go to the title company. The title company is going to hold that cash. Just as a little note, if you receive cash, if the seller actually takes cash to themselves, they're going to pay tax on that. Or if they have a reduction, if they give up property with a certain mortgage and they receive property with a smaller mortgage, that's considered tax too, that they would have to pay tax on. So there's a lot of tricky little rules that you got to follow, but if you follow them, it could be a great thing for you. After the sale, the seller has to name 3 properties within 90 days. They've got to actually write out 3 properties. They've got to give it to the qualified intermediary. And if the seller then buys one of those 3 properties within 180 days, they would not pay any tax on the sale of the first property. Cash goes right to the intermediary. The intermediary goes and buys that new property, and the seller then gets the new property and didn't pay any tax on the sale of the first one. These rules are strict rules. You've got to comply with those very closely. Third-party intermediaries, title companies, they know that. If you list 3 properties and you don't close on one of those, you lost the tax-free exchange. It's got to be one of those 3 very strict rules. Kind of a strange rule, but that is the rule.
Yeah, up to 3 properties.
What's that?
That's up to 3 properties.
Correct. Yeah, up to 3.
You don't have to.
Oh, yeah, you're right. You don't have to name 3. You can name 1. Right, 1, 2, or 3. Yeah. Is that your question also?
That was my question.
Yeah. Right. So yes, you're right. So that's, yeah.
Okay, let's say you're doing the 1031 and you have your 3 properties and you don't close on them for 180 days, you lose your intermediary third-party fee. But you can, if you don't take action on those, can you start another 1031 with the same property in the future?
The same property, you mean the property that you sold?
The property that you're wanting to do a the property that you own, that you want to do a like-kind exchange. In other words, if the first one fizzles out, that does not nullify future exchanges. Is
Right,
that correct?
that's correct. Yeah,
Okay.
if the first one you didn't meet these rules, that money's just going to be taxable. If it didn't work, the third-party intermediary is just going to give you your cash.
Okay.
What you're saying is you can do another property, you can
Yeah.
sell another property
Yeah.
and still work.
Yeah.
Is that right?
Yeah.
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 Sure. Yes.
This one's a tough question.
Okay.
You know, so you transferred your gain from the one property into the second property.
Right.
You sell, in today's economy, you sell that second property for a loss. What happens to that gain that you transferred over?
Okay, now we're getting into some technical rules. I'm familiar with that. When you sell your first property, and let's just make up a number, you have $100,000 of gain on that first property. And you go to buy another property that costs $200,000, and you actually pay $200,000 for it. Because you deferred $100,000 of gain on that first property, in other words, you didn't pay tax on $100,000 of profit, that $100,000 reduces your basis in the property that you acquired. So even though you paid $200,000 for that second property, your basis is going to be $100,000.
Okay.
So if you would go to sell that second property, you would then pay the tax on that gain. So that's why it's sometimes they call it deferred like-kind exchange, because you're really deferring the tax.
So if you sold that second property for $80,000, you negated the gain.
Well, yeah, you just compare that $80,000 to your basis in the second property.
Okay.
You
So
don't
like
get a profit or a gain.
You bought it for $200,000, your
Right.
basis is really $100,000. So if you sold it for $100,000, you don't have a gain.
Correct.
So you wouldn't have the tax.
Right.
Okay.
So you not ever pay tax on the first sale.
Yeah.
Right.
Okay.
Or the second sale. Yeah, well.
It kind of fits into this market.
Yeah, right. Yeah. Yes.
Can you do it in reverse?
Can you do it in reverse? You buy the second property first?
Buy the one that you want.
Nope.
Some years later.
I don't think that you can. No. Do you know, Matt? I don't think that you can. No. I don't think so. No. Pretty sure you can. Yeah.
There is a procedure that you can do a reverse exchange, but it's quite complicated, and the intermediary actually has to make that purchase and hold it under their name for a period, and then you back it.
Right. Right. So he's getting a little creative over there, a way to skirt around that rule. The general rule is no, you can't buy it first, but if you have somebody else buy it for you, and they transfer it to you after you sold your first property, maybe you can get in the back door. Right? Yeah, so in back.
Is there any way to eliminate the recapture tax on the sale of your first asset you're selling on 1031?
By that you mean the depreciation recapture?
Yes.
The depreciation recapture would also be deferred.
Okay.
Yeah, you would not pay the tax on the depreciation recapture. All the gain could be deferred if you meet these rules. Anybody else? Yes.
Okay, let's say you've done the 1031,
Right.
you hold it, you cease, point of death, your children take title to that property. The deferred taxes now are a moot issue, is that correct for your beneficiary?
What was that? You closed on the exchange.
You do a 1031 exchange, you die, okay? And you leave that, the moment after you die, title is given to your children or
Okay.
whoever. So at the time the title transfers, those taxes become a moot issue for the beneficiary?
Yes.
Yes.
Short answer, yes. I mean, your beneficiaries are going to get a step up in basis in that property.
Right.
I don't know if I have to bore everybody with that, but your question is the tax-free exchange done over, yes, and your heirs will get whatever you had, or they get a step up in basis if you pass away.
Okay.
Yeah. Right. Okay. All right. Another frequent question and frequent thing I do in my business and real estate practice is I regularly get questions from realtors and clients that say, I just signed a buy-sell, I'm going to buy a property. Whose name should I put it in? Should I put it in my name? Should I put it in my spouse's name? Should I put it in my kid's name? Sometimes the client will have some types of issues that they don't want others to know that they're buying the property, or they have creditor issues, or they have divorce issues, or have all kinds of issues. But that's an easy one to answer nowadays. Under current law and tax law, the best entity that you can use to purchase an investment property is to use a limited liability company, or what's known as an LLC. And there's a few reasons for that. One reason is when you create an LLC, you're actually creating a separate person or a separate entity. And that entity will actually buy the real estate and will own the real estate and will have all of the risk involved with owning real estate. You would be the owner of the LLC, but you would not own the real estate. For instance, I'll pick on Ray Pickett here. If Ray was going to go out and buy a property, Ray would form Westside LLC, and Westside, which he would be the 100% owner of. If he was a one owner, a single member LLC, that LLC would then either sign the buy-sell agreement, or it would get the buy-sell agreement assigned to him prior to the closing. That LLC then would buy the property. It would sign the bank loans. It would get a checking account for the LLC. You'd get an IRS number. Any leases that had to be signed, the LLC would sign the lease. And so all the risk and all of owning in real estate is in that LLC. And Ray himself would be the owner of it, but Ray didn't sign anything personally, so he's insulated from liability.
Is there any exceptions?
Yes.
Are there any exceptions?
Exceptions to the liability issue? There are some exceptions, and they all mostly revolve around whether you properly formed the LLC and whether you properly operated and maintained it. If you properly formed it and you followed all the corporate and legal formalities, you'll get the liability protection that it's supposed to give you. That's what it's designed for. You just have to follow the correct procedures. Yes.
What if the property was contaminated by you?
Yeah.
You transferred it to your
Right.
LLC?
That's a good question.
I think that there's a...
It's a good question. Yeah. No, there is a different rule for environmental contamination. And there's certain requirements that a buyer has to follow in buying contaminated property, getting a phase 1, getting a phase 2, maybe getting a DDA. But yeah, liability, environmental contamination can be an exception to that.
Does the LLC have to do that? If you transfer it?
The buyer and owner of the real estate has to do it. So it would be the LLC. Yeah. Yeah.
I've been advised if you have multiple rental properties to have an LLC for each one and not all together, so that keeps all of the liability separate. Is that correct?
Yeah, that's not a bad idea. Yep, have a different LLC for every property, for every development, or every project. And that's okay. One good thing about an LLC, it's a relatively inexpensive entity to form. I mean, to form a one-person LLC, our office charges $300. There's a $50 filing fee, so $350 to get your LLC. The one-person LLC does not have to file an annual tax return, Any profit or loss that the LLC has goes right on the owner's individual tax returns. There's not a lot of maintenance to it. So it's a relatively inexpensive entity. It's great for ownership of real estate. Yes?
One other exception might be is if they could prove that you formed the LLC with the intention to defrauding people, which obviously wouldn't come up. That would also be something where you lose that protection if they could prove that you formed with that intention, wouldn't it?
It might. It's not something that I've ever seen, or you talking about fraud on creditors? Yeah. Maybe. Right. If you know you have claims or debts or liability to someone, and you put it in the LLC when the debts were already existing in the creditor, then get it in the LLC, yeah, that's an issue. Right. Yes.
If you have LLC real estate, it's probably rental, which probably means you're going to end up in court sooner or later.
Going to end up what?
Which means you're probably going to end up in court sooner or later.
Oh. Somewhere
Somewhere down the line. I understand that LLCs, the owner of an LLC cannot represent himself in court, and I also understand there's some subcommittee work promoting that the LLC to be required or be allowed to represent themselves in court. I wonder if you could comment to that.
Did you say there might be legislation pending to allow that? Is that what you said?
I've heard of that, yes, in the subcommittee level.
Yeah, you're right that an owner cannot represent the LLC in court because the LLC is a separate person, and that person can't represent them unless they're a licensed attorney. So you are right on that. As far as legislation pending to allow that, I don't know of that. You know of that, Lucas?
I do not.
It would surprise me if the law would allow somebody that's not an attorney to go into court and represent somebody, but I have not heard of that. What I've been talking about is a single member LLC where one person goes and forms the LLC. An LLC is also very good and very useful where you've got more than one owner. You've got 1, 2, 3, 5, 10 people that come together to invest in a property or some kind of project. Then you have a multiple member LLC. And that works too. It's a little more expensive to form. It's probably more like $500 to $1,000 to form this multiple member LLC. And that entity actually has to file an annual tax return. So it's a little more involved, a little more costly, but it's still a great entity when you've got more than one owner. Because an LLC has to have what we call an operating agreement. And that operating agreement has all the policies and procedures of how the LLC is going to operate. It talks about how management decisions are made. Usually they're made by majority vote of the members, but it'll address what happens, how do you refinance the properties, how do you buy, sell properties, how do you sell, what are the terms of leases. You know, the operating agreement will describe how the LLC operates and how the members vote to make these management decisions. An LLC is also an excellent entity to transfer property or gifting real estate to family members. What we see mostly in our estate planning practice is we'll see a situation where mom and dad have a cottage or some other property, but they want to pass on to the next generation. So mom and dad will put the cottage or property into an LLC, and then every year they'll give like 2% or 5% or 10% to the kids, and they'll gradually just turn it over to the kids, and at some point the kids will get 51% or more, and then they'll have control of the cottage, and it's a real good vehicle to do pass ownership piecemeal like that. Otherwise, you're talking about deeds, and you're talking about putting family members on deeds, and it's very complicated and very awkward. So actually, LLC is a perfect entity to do that. Okay? Okay, self-directed IRA. This is a fairly well-kept secret for real estate investors. We all know what an IRA is. An IRA is an individual's retirement plan where you put money into the IRA, and if you generally invest in stocks, bonds, and all the interest and dividends is not taxed, right? Until you retire, then you start drawing it out, then you pay tax on the distributions. Well, there's something known as a self-directed IRA. A self-directed IRA can invest in real estate. To become a self-directed IRA, an IRA has to sign an agreement with what's known as a trustee or a custodian that's licensed to be a self-directed trustee or custodian. And for a fee, they will then serve as the trustee of your self-directed IRA. Once you do that, you sign that agreement, you convert it to a self-directed IRA. That IRA can then buy real estate. I've actually got a client right now who has a self-directed IRA, who has 2 parcels of real estate, and it seems to be working for him. Another good thing about it is IRA is not taxable if you follow the rules properly. Yes?
Now, could the self-directed IRA own the LLC that owns the property?
Yes. Yes. He asked if the self-directed IRA could own an LLC that owns real estate, and yes, you can do that. And as an IRA, any income is not taxable, so as long as the self-directed IRA owns real estate, you've got rent going into the IRA, it's not taxable. You can sell the property at a gain, it's not taxable. And essentially you can own real estate, and then eventually when you come to retirement age, you take distributions from the IRA just like any other IRA. But the difference is it can invest in real estate. All right, so folks that you may be talking to that say, geez, I don't have cash available, I can't invest in real estate. If they have an IRA, well, that's an option. Okay, another question I get. I'll get a call and someone will say, geez, I'm selling my property on a land contract and I'm going to get payments over 10 years, then I'm going to get a balloon in 10 years. Then when am I going to pay tax on this money I got coming in? Well, we have what's known as installment reporting of gain, which means that as you receive payments, you'll be taxed on those payments. If you don't receive payments in a year, you won't have any tax, you won't have any income. But the gain is deferred and all the tax is deferred until you actually receive those payments over time. I think you could elect, if you want to have it all taxed in the year of sale. But as far as I know, folks don't do that. They generally use this installment method. As they get the payments, they'll pay tax on that, on those payments. If they don't receive any, they won't pay that tax. Yes?
Purchase money mortgage.
Yeah, the question was on a purchase money mortgage, do you do it the same way? But basically by that, you mean you get a note and you receive note payments over time? I think that's what you mean. You pay the capital gain as you receive each payment. Each payment that you receive every month will have interest in it, and it'll have capital gain in it. So part of it will be interest taxed as ordinary income, and part of it will have long-term capital gain taxed as long-term capital gain rates. But the key is you're a cash basis taxpayer, and you only pay that tax when you receive the payment. Yeah, Jerry?
What are the pros and cons of purchase money mortgage versus a land contract for both buyer and seller?
If you're a buyer, they probably don't. The question was, what's the difference between buying on a mortgage and a note as opposed to buying on a land contract? If you're a buyer and you make your payments when you're supposed to make them, there's not much difference. You make your payment at the end of when the balloon comes up, 5-year, 10-year, whatever it is, you make your payment and you're going to get your deed to the property. Okay? If you don't make your payments, then you start talking about foreclosure. And there's different foreclosure procedures if you're buying on a deed or if you're buying on a land contract. I don't know if we want to get into all the different procedures, but generally with a deed, you've got a 6-month redemption period, which is probably good because you've got that 6 months to try to go get financing to save the property. You don't have a 3-month, you don't have a 6-month redemption period on a land contract. From a seller's perspective, again, as long as you're receiving the payments, a land contract and a note are the same thing. As you receive the payments, you pay tax on it. If you're not getting the payment, the buyer defaults, then you get into the whole foreclosure procedure. And then the question becomes, what's a better foreclosure procedure for the seller? Is it better to foreclose under a note or under a land contract? Well, note is a less expensive, a note and a deed is a less expensive way to foreclose. You can foreclose by advertisement. You know what that is. You can foreclose by advertisement. You don't really need an attorney to do that. If you're holding a land contract and you have to go into court, you can only sue by going into court. You have to actually file a lawsuit on a land contract. Long-winded answer, no?
Is there any redemption period on that?
No, but you have to wait 3 months. There is no redemption period on a land contract. Is that right? That's right. Yeah. Okay. Anything else there? And this is actually the last item I've done. The question I get is, boy, I'm going to sell my property. What kind of tax do I have to pay on this thing? when you held the property for more than a year, your income is taxed at long-term capital gain rates. Actually, there's an error with this slide. That 10% is supposed to be 0%. When you sell properties that you've held for more than a year, the gain is taxed at long-term capital gain rates. And long-term capital gains, that sounds like a bad thing, but it's actually a good thing. It's actually a very low tax rate. One of the last things George Bush did was pass the so-called Bush tax cuts, and that brought in the lowest capital gain rates that we've ever seen, 0% and 15%. If you're married and you have income of $70,000 or less, the long-term capital gain rate is 0. Above $70,000 of married income is 15%. If you're single and your income is $35,000 or less, the tax rate is 0. If your income is over $35,000, it's 15%, plus 4% Michigan. So the long-term capital gain rates are actually very favorable. Either 0 or 15%, and that's the lowest they've ever been. Yes?
And this is only if you're selling property, obviously your personal residence.
Correct. Yeah, this is only if you sell income property, your stocks, bonds, that you get long-term capital gain rates. Does not apply to the residents.
And long-term capital gains, 12 months or?
Yes, 12 months. Yeah, you have to hold the property 12 months in order to get those long-term capital gain rates. Yes?
This is true for 11 and 12?
The only thing that's different for 11 and 12 are those income rates, those income brackets that I gave you changed by $10. So the rates are the same. They're 0% and 15%. Now, President Obama has extended the Bush tax cuts, I think, twice. So that's the current law for a while. Yes?
Have you heard anything about that payroll tax cut? I'm actually like the accountant for a land developer, and filling out payroll tax returns and stuff like that's going to get really chaotic if they don't extend that like basically for the whole year. Have you heard that they're going to do that?
I think they just did that last week, didn't they, Matt? They just extended the payroll tax cut.
Yeah, they did.
Yeah.
Oh, okay.
I think they did. They did pass that.
Oh, good.
Right.
We should mention also on these rates, keep in mind there's an election in November. So,
Yeah.
Well, at least what my experience has been is that it seems like Congress, before they go on winter recess, that's when they like to jam in all the tax changes. So that usually happens in December. So even with potentially a new Congress coming in, you just don't know. And the really bad part is they could come in December and make it retroactive to the beginning of the year. The thing like the home buyer credit, how they made some of those changes retroactive to the beginning of the year, even though they didn't actually implement it until November. So this is something, that's why we say it is what it is now.
Yeah. The last thing I'll say in closing is that there's a lot of favorable tax laws passed for real estate, as you've seen some of them. And the biggest reason those are passed is because we've got the National Association of Realtors in Washington lobbying, and that's what they do, and that's what they want PAC money for. So if you want to keep this legislation and keep tax laws favorable to real estate, keep the PAC dollars flowing. And that's how our system works. I've also covered Lucas Calientasis, who's an associate in our office, and Lucas handles property tax appeals. And he's going to talk to you about property tax appeals. So we have one more question.
I was told that in the healthcare law, there is a 3.6% sales tax on real estate sales. Is that true? Have you seen that?
No, that's not true. I think that was talked about, but didn't make the cut.
So does this mean that we know what's in that bill?
Well, I think the tax stuff we know.
Okay, good.
Let's leave it at that. Okay, good question. Okay, fine with this. All right, thank you.
My topic is slightly different from what Matt and Ed had for you. I'm going to talk about property tax appeals, which, as I'm sure you're all aware, have become increasingly more common. This is a state tax issue in a sense, but of course involves specifically for everyone here.
We can't hear you.
Okay. Hear me? No? Yeah. Okay. I have to speak closer to the microphone.
You're too tall. You're too
Yeah.
far.
Okay. As I don't know if you know if you heard me in the back, but I'm going to talk about property tax appeals specifically as it relates to real property, taxable value of property, the SAV of property, which you may or may not have come across, but I'm guessing many of you all have. And what I tend to do is kind of.
Still can't hear.
Why don't you hold it? Good.
Is this better? Okay. All right, thank you. Okay, so what I want to do is take the whole property tax appeal concept and kind of tie it into the seller's disclosure statement and the uniform buy and sell contract. Because I think there's a few things we could fill in, especially considering the times where there are many, many, many more tax appeals being filed each year. Before I do that, before I tie it into the seller's disclosure statement and the uniform contract, I want to give you some background on the tax tribunal. It is an administrative tax court. It's not like the other courts where you commonly see litigation. It is slightly different. Specifically, the tax tribunal has exclusive jurisdiction in property tax matters. It also has jurisdiction in other tax matters such as the income tax, sales and use tax, but what we're primarily concerned about here today, I think for many of you in terms of your work, are the real property taxes. We have two divisions. We have what's called the entire tribunal and the small claims division. A little bit about the entire tribunal. This is the main body of the tax tribunal. It's actually composed of 7 members. They're appointed by the governor and confirmed by the Senate. All tax appeals may be filed with this division, and the tax appeals are heard in Lansing, just blocks away from the Capitol. One thing interesting to note, I'm going to try to tie this in with the uniform contract. Subsequent tax years are added by the taxpayer's motion. For example, the tax appeal is filed, or was filed in 2010, the attorney needs to file a motion to add subsequent years, to add 2011, and now within the next few months to add 2012 if that tax appeal has not been resolved. The reason this is becoming more and more relevant is that there are increased caseloads. If we look in 2008, there were approximately 4,500 tax appeals filed before the entire tribunal. That number went up to about 6,900 tax appeals in 2009. It went slightly down in 2010, and the tax tribunal hasn't released a figure for what the 2011 appeals were filed yet, even though we're already in 2012, and filing deadlines are fast approaching for 2012. In the small claims division, since we're talking about this increased caseload, I'll jump to the bottom of the slide, where we see a significant increase. 11,500 tax appeals filed in 2008, and if I can jump to 2010, 20,500 tax appeals filed for that year, and that's expected to have increased in 2011. They're still docketing those 2011 cases, so no official numbers have come out yet. The reason this is relevant really is a property may be sold and there is a pending tax appeal affecting that property. What do we do with it? That's the ultimate issue. That's what I'm going to try to get at here. A few other things to be aware of. There are some filing deadlines. July 31st, you need to file your tax appeal for residential and agricultural property. May 31st for all other classifications. That would include commercial properties. Where do you want to find information? Where can you find information about what has been filed, what is pending, what has been resolved? The tax tribunal website, www.michigan.gov/tax-trib, includes a docket lookup where you can search by docket number if you have one, which is probably unlikely, or you can search by name. You can put a taxpayer's name in there and pretty easily find the pending tax appeal. And once you identify tax appeal, that information will include the parcel ID number, so you can confirm that you are looking at the correct appeal, and it will also include the tax years being appealed. So how does this relate to, for example, the seller's disclosure statement? Towards the middle and bottom of the slide, I copied two provisions that appear in the statutory seller's disclosure statement. Is there any pending litigation that could affect the property? The question is a pending tax appeal litigation that could affect the property? So the ultimate issue, I think, for you, whether you're representing, well, when you're representing the seller, do I need to disclose this? The buyer is probably interested. And you know there are consequences for not disclosing pending litigation. There is some ambiguity, perhaps, in the disclosure statement, because the disclosure statement also provides that the buyer is advised that other tax appeal or other real property tax information is available for the assessor. So whether or not disclosure is actually required by the disclosure statement arguably is an unanswered question, but as you probably are aware, there are consequences to not disclosing, and it's probably better to err on the side of caution. Disclose. Exactly, when in doubt, disclose. Because if you don't disclose, a buyer may take the position that I have the right to terminate this agreement. Now you may ask, why would a buyer want to terminate a purchase agreement where there's a potential of a tax refund? Well, there's no one-size-fits-all answer. A buyer likely has a different opinion of value than a seller, and there are costs associated with pursuing tax appeal that the seller has decided to undertake, but a buyer may not want to deal with, especially considering the transfer of ownership and uncapping that results during many transactions. So one thing to keep in mind, tax appeals, my advice is that they should be disclosed on the seller's disclosure statement. Of course, this is limited to transactions where the seller's disclosure statement is required. In commercial transactions, you're not going to have this, but it's still something that perhaps during the negotiation process you probably want to disclose. Finally, looking at the uniform buy and sell contract, there are a couple of provisions here dealing with taxes and how they are prorated between the buyer and seller. Well, if there's a pending tax appeal, the biggest issue is what happens to any refund. And that's something that probably should be addressed in the agreement. And perhaps a good place for that would be under your other provisions section. How is that allocated? If you have a tax appeal that was filed in 2010, we're currently in 2012, subsequent years have been added either by motion in the entire tribunal or automatically in the small claims division. The seller, of course, is going to want the tax refund for tax years 2010, 2011, but if the transaction occurs in 2012, the seller and the buyer probably have an interest in that tax refund. And considering the taxable value in dispute, that tax refund could be rather substantial. So that's something that probably should be addressed in the agreement. Another issue to consider is the substitution of parties. In my example of a tax appeal being filed in 2010, the seller still has an interest. But on a going forward basis after the sale in 2012, the buyer is really the party in interest. And the tax tribunal rules provide a mechanism by which the buyer can be substituted for the seller. The buyer could be added as another original party or actually made a party in another capacity. So there's some flexibility there for the buyer to step in and take over the tax appeal, or at least join the tax appeal if the buyer so chooses. And I believe that these issues and more are really something that needs to be, or could be negotiated between the buyer and seller. And there is, unfortunately, no one-size-fits-all answer. This is going to be determined on a case-by-case basis, and it's probably best addressed under the other provisions of the uniform buy and sell contract. That's all I have. I'm open to any questions. Thank you.